Now let us move to the next important topic, time series based supply planning in IBP. What I am sharing here is only an introduction, and as we progress in later sessions, we will explore this area in greater depth. At a high level, time series based supply planning rests on three main pillars. These pillars are essentially defined by the planning horizon and the constraints considered during the supply planning process. The first pillar is what we call the infinite supply plan without shortages, often referred to as unconstrained supply plan. In this case, the system works under the assumption that whatever demand exists can be fully met by supply. In other words, there are no limitations. Supply will always align 100% with demand. Even if the forecasted demand appears unrealistic or overly optimistic, the system will still treat it as valid demand for the purpose of calculations. The idea here is to create a best case scenario. The system assumes that all resources, whether or not they are realistically available, can be stretched to cover demand. This helps planners see what an ideal world would look like and what type of supply arrangements would theoretically be required to meet that demand. While this may not be feasible in real world execution, it gives organizations a benchmark and helps identify gaps when comparing with more realistic constraint plans. The second pillar is the finite supply plan, which is built on a system of priorities. Unlike the infinite plan, this one recognizes that supply is limited and that trade offs must be made. Priorities are defined based on the organization's strategic rules and objectives. For instance, if two customers place orders simultaneously, the system must decide which order should be fulfilled first. The decision depends on the company's strategy. Let us consider an example. Suppose there are two customers, customer A and customer B. If the organization's strategy is focused on maximizing profitability, the system will evaluate which customer's order contributes more profit. If customer B is offering higher price for the product, then customer B will be prioritized even if customer A placed the order earlier. The logic here is clear. By fulfilling customer B's demand, the company maximizes its profit, which aligns its strategic rule. On the other hand, if the organization's strategy emphasizes managing key accounts or customer loyalty, then the situation changes. Imagine customer A is a long standing client associated with the company for decades and enjoys a discounted rate because of this loyalty. Customer B, meanwhile, is a newer client offering a higher price. In this scenario, even though supplying to customer B brings higher profit, the system prioritizes customer A because the company's strategy values loyalty and long term relationships. These rules, whether based on profitability, customer loyalty, or other strategic factors, are configured in IBP. The system then uses them to make consistent and transparent allocation decisions during supply planning. The third pillar is the heuristic infinite supply plan with allocations, which works slightly differently. Here, the system only propagates supply that is actually available. Let us take another example. Suppose two customers each place an order of 10,000 units, making the total demand 20,000 units. However, the supply available is only 10,000 units. In such a case, the system cannot meet both demands fully. This is where allocation logic comes into play. The allocation process again depends on the organization's strategic parameters. If the strategy prioritizes profitability, then the customer offering the higher margin gets a larger share of the limited supply. If loyalty is the decision factor, then the loyal customers receive pers- preference even if it means lower short term profit. Sometimes companies may apply a hybrid rule where a combination of factors, profitability, customer type, geography, or product segmentation, determine the allocation. The system follows these predefined rules to split the available supply among customers A, B, C, or D. In this way, supply planning in IBP is not simply about generating numbers, it is about making structured, strategy aligned decisions. The outcomes are shaped by the master data and the business rules configured within the tool. These rules ensure that when supply is limited, planners are not making ad hoc or inconsistent decisions. Instead, IBP provides a structured framework that aligns tactical supply planning with the company's broader strategic objectives. To summarize, the three pillars of time series based supply planning can be thought of as three different lenses. Unconstrained infinite plan assumes everything is possible and creates a best case scenario where supply always matches demand. Finite plan with priorities recognizes real world limitations and allocates supply based on the organization's defined strategic rules such as profitability or customer loyalty. Heuristic infinite plan with allocations works with actual available supply and uses allocation rules to distribute limited resources fairly and strategically. These pillars work together to give planners a complete view from ideal world planning to realistic allocation decisions. By comparing unconstrained and constrained scenarios, organizations can identify gaps, evaluate risks, and make better informed choices about investments, priorities, and customer commitments. This is only a high level introduction, but it already shows how IBP transforms supply planning from a routine scheduling activity into a strategic decision making process. As we move forward, we will dive deeper into each of these pillars, explore how they are configured, and see examples of how they play out in real business environments.